I'm joined here with John Starling and Sarah Starling, so you can see the three of us. I just want to do a few housekeeping items before we start, in that today's session is going to be recorded. So if you don't feel comfortable being recorded, you can certainly disconnect now. We will be recording this and sending it out after, so you will receive this presentation. But just so you know that if you do speak, it's going to be recorded and sent out. So today, like I said,
Don't be intimidated by that. We're not going to use it as a negative towards you.
no, I know that's our legal disclosure. So today we are going to be talking about understanding tax basis and understanding capital gains taxes and all of that and what that includes. So if John and Sarah, if you want to introduce yourselves real quick, we can get started after.
Okay, great. So Sarah, my cohort in crime here, along with Michelle, has been with us as an active qualified intermediary for the last 10 years or so, and she and I have been together working from Wilmington, North Carolina. We also have offices in Woburn, which is the home office of Northern Bank and Trust, and we've been involved in 1031 exchanges for over 20 years, and we've helped thousands of people avoid tax when they sell their relinquished or when they sell their investment property and acquire replacement property. So Michelle, I guess we're going to get started if you want to.
Sure.
On the slide presentation, right?
Yeah, so we always start with just talking about the real basics of 1031 exchange. We always want to give people the overview. These are the questions that we get asked every single day. And, it's always regarding what an exchange is. And this is an exchange. So the IRS has a code called 1031, and it basically says that no gain or loss shall be recognized on the exchange of real property. And we highlight real because it's just strictly for real estate now, held for productive use in a trade or a business, or for investment. If the property is exchanged solely for another type of real property, which again has to be held for either productive use in trade or business or for investment purposes. So
Michelle, when you're thinking about this real property versus personal property, I just had a call yesterday where someone said, "Hey, John, I want to buy a replacement property that's a gun range and it's an active gun range, and they want to sell me the business as well." And I'm going, "Well, fine, you can buy the business, but you can't 1031 exchange into the business. You can exchange into the land that the gun range is on and the building that the gun range is housed in, but the actual business itself of helping people learn how to shoot guns would be not exchangeable. So whatever you decide to pay for the business, you're going to have to not, that won't count towards the purchase price. So, the idea is pay as much for the land and as little for the business as possible in that situation.
That's right. Yeah, and we're actually doing a car wash right now too. So there's a lot of those examples that happen. And it's important to just make sure that you break out those two transactions, distinguish the difference between the real property and the personal property. And if you can get as much value for the land as you can, that's the way to go. So this is an exchange. It's pretty straightforward. John, do you want to go through this, or Sarah, do you want to go through this and kind of go through what an exchange looks like?
Well, the idea here, I think, Michelle, is that you have to have an intermediary, which is the man in the middle. The qualified intermediary then becomes the person that you swap with. You are the taxpayer if you are trying to sell your property and not pay taxes. And when you exchange, that means you have to have someone to exchange with. So, if you sell to one party and buy from another, you're just doing a sale and a purchase, and that is a fully taxable transaction. By hiring a qualified intermediary, such as Northern 1031 Exchange, you are putting that qualified intermediary in the position of being the person you sell your relinquished property to, and then being the person that you buy your replacement property from. Hence, we say you can't touch the money, right? When people say, well, what happens to the proceeds from the sale? It goes to us because we are actually buying the property from you and selling it to the buyer. But you get to direct deed it to the buyer, which is over on the left-hand side, and then the money comes to us as the qualified intermediary in the middle, and then we use the money to pay to the seller of the property that you intend to buy, and the seller then can directly deed the property to you as the taxpayer. So that kind of completes our circle.
Right, and here's the million-dollar question: what's the time frame for doing all of that and completing an
Sarah?
exchange?
Yeah, so you've got 45 days from the date of the closing of your relinquished property to identify. You can identify up to 3 potential replacement properties. There's another way to identify, but most people use the 3 property rule. And then you have 180 days total to close on your replacement properties. That starts on the same date as your closing of your relinquished. So 45 to ID and 180 to close.
And remember that those are calendar days. If that falls on, New Year's Day or Christmas Day or a holiday, just make sure that, or a Sunday, just make sure that you have to close before the 180th day.
Oh, yep. That's no exceptions on that.
No, there are no exceptions. And people ask that a lot. And, the only exceptions would be if there are federal disasters or an extension claimed. The federal government will claim an extension, or will grant an extension, I should say.
They
But
don't
that's
grant extensions for individuals. They only grant extensions for regions of the country
That's right.
if
Like
there's a
Hurricane
disaster.
Ian. Yes, so Hurricane Ian, the people that were affected by the hurricane, there was an extension granted in that area last year. So here are some of the things that do not qualify for 1031 exchanges. We talked about how the properties have to be held for business use or investment purposes. These do not qualify. Personal residences, so that primary residence where you live. Your second home that is used exclusively for personal use. So that is not an exchangeable property. Those second homes don't really have a whole lot of tax benefits. You would have to claim your second home as a vacation rental, and we can get into that a little bit more, but just so you know that your second home would not qualify. A stock in trade or properties purchased for quick resale. So those flippers, the people that are purchasing properties and want to turn around and sell them really quickly. Fix them up and sell them out, sell them. Stocks, bonds, or notes do not qualify. Securities, interest in partnerships, in certificates of trust or beneficial interest. So none of those will qualify as exchangeable property. Anybody want to take this, or you want me to go?
Go ahead. Go ahead, Sarah.
Okay, so we've got types, formats, and variations. So we can do a 2-party trade, which is a swap, and that you don't need a qualified intermediary to handle that. So you're selling to a buyer, and that buyer is selling to you, and that's very rare. That's like a needle in a haystack situation. So those just don't come up that often. The delayed exchanges with a qualified intermediary, that's us, and that's what you'll be doing, or your clients will be doing normally, and that's the most common exchange. Multiple sales and acquisitions, so you can sell several pieces of real estate and combine it into one or multiple. You can sell 2 and buy 1. I call that a twofer. You can do a reverse exchange where you buy and then you sell. Improvement exchange, where you can improve upon your land. Well, not your land yet, but upon the land that you purchase prior to the acquisition. Personal property exchanges are now excluded from 1031 treatment. That was outside of the code back during the Trump administration. So again, I think we mentioned that earlier, just real estate now that we can do 1031 exchanges on, and then combinations thereof.
Yeah, so we see reverse exchanges that are combined with a forward exchange actually quite a bit. So that's a very common combination. So we do see those combinations a lot.
Person decides to buy a replacement property, but it's not enough. In other words, if their relinquished property is selling for a lot more than the one that they want to buy immediately, they can go ahead and buy that one and then do a partial so that when they do sell their relinquished property, they can then have another 6 months to find the second property.
Yeah, I think we're actually working on one of those right now. So that's kind of a nice scenario.
Yeah, and you know, a lot of people are saying, well, I want to fix it up. If it's a remodel, then we do this improvement exchange where, you know, we can use 1031 funds to rehab an existing property, but the rehab has to be completed or all the money has to be spent within 6 months of the date of the sale of the relinquished property.
Right. Those are timing sometimes is a little bit difficult with those, but we've done quite a few of them. So it's definitely possible. I guess really depending on what type of improvements you want to do.
Let's get into now, so let's see their tax returns, how investors increase their rate of return. Oh boy.
So and these are really the reasons why people exchange. This is kind of what we see over and over again. People calling us and saying, you know what, I'm young, I'm 30 years old, I'm just getting into real estate. Well, what they're really trying to do is build their portfolio. They're trying to get bigger and better properties. They're trying to leverage up, borrowing more money to buy better properties that are in better locations and areas. And that's typically done with those younger investors. Same with diversification. They are starting to, they may have one property where it's worth a lot of money in a good location, and they may go out and buy a bunch of different properties, maybe smaller, in some different areas that they're trying to break into. So you can certainly sell one property, one bigger property, and buy multiple smaller ones. As we get into the more seasoned, I think, investors, we get into the people that are looking to consolidate, that have those properties all over the city and want to just consolidate into one commercial property or one apartment complex, make give them a little bit of management relief, give them maybe better cash flow. So that happens a lot. Increasing depreciation is an option if you're buying up in value. So that may be something that they're looking at. And I think, honestly, I think we see a lot of people that are just trying to estate plan, that are just saying, you know what, I've owned this property for 40 years. I have 3 kids. None of them talk to each other. Let's try to buy 3 different condos and we can, leave one condo to each one of my kids. Or they're thinking about buying a property down in Florida that they may eventually retire into, that they can rent out for 5, 6 years before retirement. And that's a conversation we have a lot, is regarding their estate plan and what to do with this asset that they have. So this is a fun one, John. You can talk about this. The
Okay.
taxes.
Well, so how much are your taxes? And of course, the federal government is looking to take 15 or 20% right off the top, called capital gains tax, and that is based on your income. So if you're in the highest income tax bracket, then you're going to pay 20% capital gains. If you're in any other bracket other than the highest, you're going to pay 15%. The highest tax bracket, if you're married, is about $470,000 per year in income. If you're single, I think it's around 400 or 410, 415, something like that. So if you're if your income is higher than 410, if you're single, then you're going to be 20%. If it's less, you're going to be at 15. But 15 is just the beginning of the taxes. You've also got the federal 3.8% tax that's called the net investment income tax. We call it NIIT for short, just taking the first letters of the four words, net investment income tax. It used to be called the Medicare circuit tax, Medicare,
Yeah.
and they switched it over later on, and now then you've got the state tax, which is 5% in Massachusetts, and you've also got a new state tax, Michelle.
Oh, this is a fun one. So we in Massachusetts, so if you're not in Massachusetts, it won't apply to you, but in Massachusetts, as of January 1st, 2023, so just this year, we implemented a millionaire's tax. So any dollar over $1 million in income would be taxed an additional 4% on top of the 5% tax. So, and honestly, they call it a millionaire's tax, which I find frustrating because it's really not a millionaire's tax. It's for most of our clients. A lot of our clients will fall into this. They have an appreciated asset. It may sell, over $750,000. Combine that with their, their annual income, their salaries, their W-2s, their 1099s, everything. That usually bumps them up into this millionaire's tax. So they're going to get this additional tax, which is that pill is a hard one for me to swallow.
Right, and that 4% is on the excess above $1 million. So you get another 4% on top of the 5% state tax. So it's
That's right.
9% on everything above $1 million.
That's right.
For state calculating purposes. And then finally, you've got the federal depreciation recapture, which is at 25%. So if you've taken depreciation over the life of over the term that you've owned the property, then you're going to have to recapture that at 25%. We're going to talk about that some more in the next few slides.
Yeah. Yeah, and I mean, you can see that those taxes add up really, really quickly. So, and this is just a good example to show how the taxes break down. So if somebody purchased a property for $500,000, and they put in $50,000 worth of improvements, and they took $150,000 worth of depreciation over the 10 years that they've owned the property, their basis is $400,000. So we're going to talk a little bit about what basis is, and that's really what we're talking about today. But how does that basis affect what the taxes are going to be? So if we go down and we say, okay, so they bought it for $500,000, now they're selling it for $1.2 million 10 years later. We're taking out the basis, which is that $400,000, and we're taking out the cost of the sale. So the attorney fees, the realtor fees, the closing costs, things like that, it's going to cost them $80,000. That means their capital gain is $720,000 on that sale. Again,
so you're telling me that whatever I owe on a mortgage has nothing to do with my taxes.
That's right, unfortunately. And we didn't even show what a mortgage looks like in here, but that's right. You're still going to owe. If you had a $400,000 mortgage on this property and you only walked away with $320,000, you're going to still pay taxes on that mortgage. So let's break it down. We've got 25% of this $150,000 in depreciation. So can you see my pointer?
Yes.
Okay, good. So that 25% is $37,500. So that's just what you're paying in recapture depreciation. With the federal capital gains, I think I did this at 20% because we're obviously over that threshold. So we're going to take that $720,000 gain and we're going to times it by 20%, which is going to give us this $114,000. Same thing, we're going to take the 720 and we're going to times it by this 3.8% and we're going to get that 27,365. And Massachusetts state tax. Now I didn't add sorry, I did this at 5.1%, it should be 5, but I didn't add in the, Massachusetts, millionaire's tax because it doesn't apply to this particular scenario. But we're gonna say that the Mass state tax is 36,000. So on this sale, bought for 5, sold for 1.2, you are paying $215,000 in taxes. So that's always a shocking
Big.
number to people.
It's
And
big.
remember, if you had a mortgage, you're taking that out of the proceeds. So that's, it's a big
Yeah.
number.
And remember, the millionaire's tax will kick in because if you have income of, more than 300,000 from other sources, because
Yeah.
you're at 700,000 now in
That's
total
right.
income just from the sale of this property.
Mm.
So if you're over 300,000 in other income from other sources, then that millionaire's tax comes in to bite you a little bit deeper.
Yeah. So
Okay.
So let's talk about basis. John, you can take this and what determines tax basis. We get this question a lot because people don't really understand what their tax basis is and how they're determining it.
Most people that call us say, okay, well, my mortgage is 700,000 and I'm selling the property for $1 million, so I've got $300,000 worth of profit.
Yeah.
Well, that's just totally wrong. The IRS only cares about how much you paid for it versus how much you sold it for. What's the difference between the two? Because that would be considered your profit. Well, that's a simplification because what you paid for it, if you didn't have the opportunity to depreciate, would be the right number. But if you've owned it for a year or more, then you have taken depreciation if it's investment property, and depreciation is a wonderful thing, right? Everybody understand what depreciation is. It's a credit that you get when you look at how much income you've received from the property. You get to deduct depreciation or a fixed amount from that income and not have to pay tax on that portion. So if I'm making $25,000 rental income on this particular property this year, but I'm taking depreciation of 12,000, then I'm only going to pay tax on 12,000, the difference between the depreciation and the actual income itself. And so when you say the cost basis can be adjusted up or down, what we're saying is that's how the cost basis goes down every year, is through depreciation. Everybody following me on that?
Mm-hmm.
Through depreciation, your cost basis is going down every year. And so when you figure out how much you're going to have to pay in tax, that means you're going to have to pay more every year in tax. Now, your cost basis can go up if you improve the property. So let's say you put a new roof on the property, or you decide to put new windows in. Then those would be capital improvements, and you would be able to add that to your basis. Now, if you try to subtract that as a maintenance item, then it does not add to your basis, and therefore it's only good during that year that you expensed it. So there's a difference between expensing maintenance items and capital improvements. So like if you paint your property, would that be?
That'd be an immediate, that would not be a capital improvement.
That would not be a capital improvement. That would be a maintenance item, and you could deduct that this year, but it wouldn't increase your basis for later on when you decide to sell the property. So the basis is increased by adding these capital improvements. So in our case, on our last example, we took depreciation over the course of the 10 years that we owned it. We took $15,000 a year times 10 years was 150,000 in that last slide. And we subtracted that from the basis. Isn't that right, Michelle?
That's right.
And did we add any? We didn't. Yeah, we did. We had some capital
grand.
Improvements of 50 grand.
Maybe they did
You can
replace the
see,
roof.
yeah, put your cursor there. So we they put a new roof on.
Yeah.
Right. Okay. So So in this case, we raised our capital basis by adding a new roof, but then we subtracted from our basis because we took depreciation every year. And again, that depreciation allows us not to have to pay tax on part of the income that we make. Now, depreciation on residential properties is fixed by the IRS at 27.5 years. And what is it on commercial?
39.
39.
Yeah, 39 in residential. On commercial, right. So you don't get to take as much per year on residential because you have to divide what you pay for it by 39. And of course, you have to take the land out because you can't depreciate the land. Land is always going to be there, right? The depreciation, the idea behind depreciation is that a building is going to.
Yeah, if you just left it alone for 27 years, it would be in toothpicks.
It would be in bad shape.
Yeah. But not necessarily.
Okay.
Hey, John, but before you go on from this topic, this is Kent. I just wanted to mention, you might already have this in your slide presentation, but we've been seeing a lot more people use cost segregation to kind of, supercharge their deductions and expenses up front. And just wanted to mention that, if people are using cost segregation and they're moving from, let's say, that 39 or the 27.5 year depreciation schedules to more like 15, 10, 7, or 5, if it's HVAC systems or, carpeting or things like that, that would be subject to ordinary income tax rates, not the 25% depreciation. So I think it's maybe an important distinction if any of your listeners, have used cost segregation and know that, some of depreciation won't be taxed just at the 25% rate, but it could be as high as ordinary income tax rates at that 37%.
That's a really, really good point, Kent. Thank you.
Yep. And then when they buy their replacement property, they've got to be able to utilize that replacement property if they're going to be able to defer tax. Then they're going to have cost segregation on their replacement property also. Isn't that right, Ken?
That is absolutely correct. Yeah, and we see a lot of people that don't understand that they really, because you're moving, I don't want to rattle code sections here, but you're taking, 1250, real property, as Michelle described, and for depreciation purposes, you're moving it to 1245. So it's not really personal property, but it's personal property for depreciation schedule purposes. And so when you do complete that 1031, you're absolutely correct. You need to make sure that you're replacing, debt for debt and equity for equity, as you guys always teach us. But you also need to be cognizant of that, bonus depreciation, or that it has to be replaced, in exchange through the 1031 process.
So, that brings up a point about sometimes people go dramatically in a different direction where they want to buy just land. They want to buy a farm, or they want to buy some hunting land, or they want to just buy a lot. And there's no structure on that property that they're buying as their replacement property. Then you've got all of the depreciation, which is going to have to get recaptured at the time. Even though you're doing a 1031 exchange, you're going to have to pay tax on the recapture of the depreciation. And I think they call it unrecaptured depreciation tax. So they can confuse us. Okay.
Great. You want to talk about stepped up basis a little bit, and really the benefits of stepped up?
Okay, so cost basis is what determines the taxes owed. Many investors defer taxes by exchanging until their death, so their heirs realize the tax benefits with a stepped up basis.
So what do we say? What do we say? You swap until you drop.
Exactly.
Yeah.
Swap until you drop.
And you'll never owe the tax. And your children will not owe the tax either, which is a great, wonderful way to pass on your generational wealth,
So, Sarah, you're saying when I die, you're going to have
We're not talking about that. Right?
You're going to have a little party because you're going to be able to sell the property that you're inheriting from me and not pay any tax because you
It's
give a
inherent.
stepped up basis to the date of my death.
Yeah, it's inherited at the value at the time of your passing, but that's way far away, so it's a bad example.
Well, let's hope so. Yeah.
We're not banking on that, John.
Yeah. So, this is the way that when we're dealing with people that are planning their estates, it's just so much better for them. They feel like they want to get, um, they want to get less involved with their real estate. And so they want to sell their real estate. But then when they sell it and they don't do an exchange, then they're going to pay the tax versus if they were able to just buy into replacement property that they might not have to be involved with management on, like Delaware Statutory Trust or triple net lease properties by corporate entities. Then they can pass on that extra 30 or 35% that they're going to have to pay in tax now on to their children, which could be a substantial help for the future generation.
John, I think it's we have a lot of people that we talk to that we talk about the stepped up in basis, and they don't even realize that that is an option. And a lot of people don't realize that they don't have to be in those, heavily managed properties, that DSTs are an option. And we can certainly have Kent chime in as well to discuss. Just Kent, I don't want to put you on the spot, but if you want to give everybody just a 2-minute overview of what a DST is, that
Sure.
would be
Yeah.
appreciated.
No problem. Well, again, I can say that you guys have done a great job, educating everyone about the nuances of 1031, which have been part of the tax codes for over 100 years, since 1921. Well, Delaware Statutory Trust, or DSTs, have been part of the tax code since 2004. And essentially, it allows someone who does not want to continue being an active landlord still complete a 1031 exchange, have all the benefits of investing in real estate without being an active landlord. So they would basically, the analogy I like to give is if someone were to buy and sell stocks, they have to do their own research, their own trading and execution, so forth, which is analogous of being a hands-on landlord. If I want to go use a mutual fund where I have a professional manager, I can look at track records, histories, fees, expenses, so forth, then that's analogous to a DST, where you're basically partnering with a professional management firm. You can look at their track record. You can diversify in different asset classes, different geographic areas. So it's a really more of a passive approach to being able to fulfill a 1031 exchange.
Love it.
How was that?
That was perfect. That was concise. That was informative. That was exactly what I think everybody wanted, because we get a lot of people that don't know that there are other options. And when we bring up DSTs, it's certainly something that's new to most people and most exchangers.
Yeah,
and the exchange process is new to most of our investors as well. This is not something that our average investor is aware of. So it's good to be able to educate them on the benefits and educate them on some of the solutions that they have available.
All right.
Yeah, and just one last thing I would say, it is for accredited investors. You are buying fractional ownership in real estate, but it's it is an option that people should explore. What I say is use it as a backup plan too, because if they're dead set on buying that multifamily or whatnot, and it doesn't go through, well, that, as you said before, that 45-day clock is still ticking, and you don't want to trigger the taxes. So DSTs can also be a good backup plan too.
And
we'll-
just to elaborate one more minute on Ken's statement about you have to be an accredited investor in order to buy Delaware Statutory Trust. An accredited investor, for those of you that don't know, is someone that has a net worth of $1 million, including everything, all of his assets other than his primary residence. So that's just, the one. Sometimes that could be a block for someone that's that doesn't have a lot of net worth, but they do want to preserve as much of their wealth as they can when they're selling an investment property, if their net worth is not significant enough to qualify, then they would have to buy real property rather than a wholly owned real property rather than a fractional interest as a Delaware statutory trust.
And one
Okay.
question I'll ask Kent, will they get a stepped up in basis if they die with a DST?
Yeah, that's an excellent question. So all the same benefits, step up in basis, the depreciation offset. Again, we mentioned about, if someone did cost segregation, I think there's an ability to complete those exchanges for cost segregated real assets as well. So there are, there's liquidity, there's different asset classes, there's a number of different, similar benefits to direct investing.
Perfect. Thanks for jumping in, Kent. I appreciate it.
Okay.
We'll do something on replacement properties soon, because
Sure.
I think that this is something that would be interesting to a lot of people. So we just put together this next slide just to help you determine, really just put a visual on that that cost basis, determining your net adjusted basis. And it's very similar to the slide that we had before. Same thing, purchase price was $500,000. You put in $100,000 worth of improvement. You took $150,000 worth of depreciation, which brings your cost basis to $450,000. So, the higher your cost basis, the better you are, the better off you are. The lower the cost basis, the more taxes you're going to be subject to, or the higher the taxes will be. And again, this is just another breakdown of the taxes that are paid on a sale of that $450,000 sale. So we already kind of went through that, so I don't think we really need to go through that again.
Okay.
Unless somebody has questions about it, but I think we already went through. But it really just gives you a picture on how much taxes would be owed.
Right.
So John, if you want to take this, I think as we talk about how people are paying an exorbitant amount of taxes if they don't exchange, this question comes up a lot as well. So when we talk about your primary residence.
The code 1031, of course, is related to exchanging and not having to pay tax on your investment property. Code 121 is on your primary residence. So this does kind of go hand in hand when you're involved in selling your primary residence. Sometimes people have primary residences that are one side of a duplex or a triple decker, is what I think we call them in Massachusetts. Sometimes when you have a three, a building that houses three families. So 121 says that you get up to 500,000 on your primary residence if you're married, 250,000 if you're single. The gain in excess of 500,000 is subject to tax, and the home must be a primary residence for both spouses for 2 out of the last 5 years. So if you've lived in it for 2 out of the last 5, then you qualify for 121 exemption of up to 500,000. 121 exclusion available once every 2 years. So in other words, it's not a once in a lifetime thing anymore. There was a one-time exclusion for primary residences back in the day, but now you could actually buy and live in a place for 2 years and then sell it and move to another home and live in it for 2 years and then sell that and never pay any tax as long as you don't pay, as long as your profit is not in excess of 500,000. You just have to make sure that your husband or your wife is agreeable to making all those moves as well. Right, Michelle?
Yeah.
So, yeah. So Sarah knows that her mom and her dad moved quite a bit when she was young, and then we didn't move there.
Yeah.
We kind of
Mom got tired of it.
Mom got tired, so I didn't get my tax breaks anymore. So unfortunately, so
But if you're single, you could take 250
Right.
So that's also,
Right. Single
benefit.
person can take up to 250,000. Now, if this can play like if you're going to make more than 500,000, you may want to consider renting the property out for a couple of years, and then you'll still get your 500,000 because you have lived in it for at least 2 out of the last 5. But if you've rented it for the last 2, then any profit in excess of the 500,000 could be shielded as long as you buy replacement property.
Yeah, that's a good point. In values in Massachusetts have skyrocketed in the last few years. So there are a lot of people that have easily gone over that $500,000 gain in their properties. So we do have that conversation pretty regularly with people in their options if they don't want to pay anything, they don't want to pay taxes on their primary residence.
Right. Yep.
So
And then
good.
we have other families, lots of families that, are living in the duplex, and then they get their primary residence exemption on their side of the duplex, and then all they have to do is reinvest for the value of the other side of the duplex, or the upper or lower unit, under 1031, and then they can shield their profit on both their primary and their investment portion of the duplex.
That is a popular one as well, John.
Mm-hmm.
So yeah, I think we just kind of hit this slide as well. We talked about the 2 of the last 5 years. We talked about the 250,000 and the $500,000 limit. So I think we hit all of that. And then we're just kind of coming to the conclusion of our presentation. So we just want to let everybody know that, qualified intermediaries are not all created equal, and it is really important to understand who the qualified intermediary is. Unfortunately, it's not one of those overly regulated or licensed industries. So understanding who the qualified intermediary is for your investor is important. And here are some of the things that you should know. How are the funds held for the client? What are the requirements for the deposit and the withdrawal? Does the QI, the qualified intermediary, have state-of-the-art fraud protection in place? Does the qualified intermediary get audited by an independent third-party auditor? And is the QI a member of the Federation of Exchange Accommodators? So those are all things that, as Northern, this is something that we pride ourselves in. We are bank-owned, a wholly owned subsidiary of Northern Bank. So the funds are always under dual control. We do have auditors. We're members of the Federation of Exchange Accommodators, and we have everything in place to hold the funds securely for our clients. So just be on the lookout. There are always the people that are online that are doing it cheaper and, for a flat fee of $300. But just ask those questions before moving forward. And here's our information. So you can give us a call. John, sorry, Sarah, I didn't know you were going to be hopping on today, but I'm going to put you in for next one. So, but this is John and I's information. So feel free to jot it down if you have any questions. You can unmute yourself and we'll answer questions. Anybody?
Sounds like you did a good job, Michelle.
Oh, I'm gonna pat myself on the back. Jonathan, if there's anything that you had questions
there we go. We got one. Mark.
Hello.
Right.
Thank you. Nice presentation. I have a question that may be very, very simple and obvious, but is the goal of finding the three properties to find them at the same price range at which you're selling, or let's assume that let's assume a property sold for $1.5 million, but there's a mortgage of $500,000. So once the seller gets his proceeds, he only has $100 million unless he goes and leverages the new one. So how does that work?
So that goes back to the basic 2 questions. You've got in order to satisfy and have an exchange where you don't have to pay tax, you got to do two things. You've got to buy equal or greater in value minus cost of sale, and you have to use all the cash that comes from the transaction. So in your example, you've got $1 million in cash that came from the transaction, which you have to put in, and you're going to have to mortgage up again, or either take $500,000 out of your pocket or out of your savings to buy that replacement property, because rule number one is you have to buy equal or greater in value, or you're going to have to pay tax on the difference if you buy down in value.
All right, thank you. It was a simple question, I guess.
Thank you for the question. It was a good question. And we get a lot of people talking about that. And, you started off saying, well, what about this 3 property rule? And, if you're intending to buy just one replacement property, then the reason for the 3 property rule is so that you can have a couple of backups in case after the 45th day you haven't closed, but your property, you can't buy it for some reason. Let's say it falls out on you because the seller reneges, or you find out through inspections after the 45th day that there's a problem with settling of the foundation, and you don't want to have to struggle with foundational issues, or you find out something about the zoning that you didn't know that would preclude you from wanting to buy the property. Then if you've passed your 45th day for identification, then you have to rely on hopefully procuring a contract on one of the other 2 properties that you named, which of course you might not be able to do just because the market is still brisk, and those 2 properties might have been sold during the time when you thought you were under contract with the first property, but maybe not. As the market cools, that 3 property rule becomes more effective. Any other questions?
Hi, Michelle. This is Jonathan. I have one question. This maybe also be very obvious. So, hypothetically, I'm a seller of a exchange property, and I'm selling to such and such an individual, and I understand that the funds that I'm going to receive need to be held by the qualified intermediary. Does the qualified intermediary appear in any of the documentation between the seller and the buyer? Or in other words, like the P&S or the offer, or is there a separate relationship just between the seller and the qualified intermediary?
That's a good question, Jonathan. So we do all of our exchange documents between the qualified intermediary and the exchanger, the investor, the taxpayer, the seller, whatever you want to call yourself. So we have a set of documents stating that you're doing the exchange. But what we do is we have you are assigning your purchase and sale agreement contract to us. So at the sale, we do reach out to the settlement attorney, and there is specific language that goes on the HUD statement that shows that Northern 1031 Exchange is the qualified intermediary for you, and that the proceeds will come to you. So we do sign off on the settlement statement. The purchase and sale, we have recommended language if you want to put it into the purchase and sale. However, it's not a requirement. There are often times where purchase and sale agreements are drafted and executed, and the client comes to us a week before the closing, realizing that an exchange is an option. So we do not require or need the purchase and sale to be redrafted with that exchange language in it. If you want to put it in, it's certainly something that we can provide, though. And the buyer will be required to just sign, not required, but asked to sign a form at the closing as well, indicating that an exchange is being done.
It's the responsibility of the qualified intermediary to inform the non-exchanging party that the exchanging party is in a 1031 exchange. We don't have to have him sign, but he has to be informed. So we ask him to sign a statement on the settlement statement and a copy of the assignment agreement, just so that the non-exchanging party so that we have proof that the non-exchanging party has been informed. If he refuses to sign, then we don't require him to sign in order to complete the sale transaction for you.
Got it. So the qualified intermediary does not get involved until at the time of closing. Theoretically, the offer, the P&S, that can all be done between the two parties. The qualified intermediary does not need to hold those funds.
When you say hold those funds, you're talking about like the deposit?
Correct.
Right. The deposit has to be given to the qualified intermediary at the time of the closing, though. So if the deposit is being held by a third party, then it has to come to the closing table and be taken into the exchange account that the intermediary holds. If the deposit is being held by the exchanger, whereas in other words, the deposit was given directly to you as the seller, you can take it. It doesn't taint the exchange, but you have to turn it over to us just prior to the closing.
Understood. Thank you very much.
Good question.
We have any more questions? So I think we can wrap up now. I do appreciate everybody joining the call. Like I said, this presentation will be sent to you as soon as we disconnect, and feel free to reach out to John, myself, or Sarah for anything that you want to talk about after this. Thank you all for joining.
Pleasure to help you guys.